Hey, gang. Zoom recording. All right. All right, recording. So we're going to work in Excel today, continuing with chapter 14. We are going to work through an initial evaluation, a basic evaluation of a capital budgeting exercise. So some data that you should see right now. Minimize this. And shout at me if literally shout at me if something goes off track and you can't see, or you need it bigger, because I may not see the chat. If you send me a chat, it doesn't make any noise, and so I'm not always looking. Okay, so we're going to assume that we're looking at purchasing a piece of equipment that is going to be added on to an existing business. And this piece of equipment is going to allow us to generate some revenue. It's going to have some cost associated with it. So what we're going to do is build a budget and kind of a P&L to go with this asset. So we're going to assume, let's say it's some sort of scanner. Okay, so we are going to assume that it's capable of doing 5,000 scans per year, okay? And we're going to assume that it gets, we earn $80 in revenue per scan, that we have $40 in supply costs per scan, that we have labor costs of 100,000, so that's a fixed cost, right? So the supply cost is a supply per scan, so that would be a variable cost. Labor, 100,000 is a fixed cost. We're going to have some overhead that's going to be allocated to this activity, right? So going back to chapter 6. We are going to assume that each year that we're operating, that we're going to have kind of a global inflation cost assigned. We're going to assume that the corporate cost of capital is 10%. We're going to assume that we are a not-for-profit, and so therefore we're not going to pay taxes. The equipment itself is going to cost $240,000. Let me add one item: useful life. It's going to assume that this project has that this equipment has a useful life of 4 years. And we're going to assume that we can sell the equipment maybe for scrap at the end of 4 years for $25,000. Okay, so these are all the assumptions that we're going to make in order to start to develop our analysis, right? So the question we're trying to answer is, should we invest in this piece of equipment? So in order to do that, we're going to start to build our budget, estimate our budget. So follow along with me as much as you can. I'm going to go ahead and just jot in year here, and then I'm going to start with time 0 or year 0, year 1, year 2, year 3, year 4. All right? And my first investment, my first cash flow is going to be the purchase of the equipment. Now the equipment is going to cost us a total of $240,000. And so that is going to be a negative cash flow, 240. And I'm going to go ahead and just make all these, I've reformatted them. So I'm highlighting a bunch of rows. I may need to highlight a few more rows. I highlighted the rows, and then I clicked on the comma style, right, to turn it into kind of accounting style formatting. And then I reduced the number of, so you can control the number of decimals that you see. I don't really care about the decimals, so I'm just going to leave it as like so, right? So in year 0, right, at time 0, which is the purchase of the equipment, I'm going to spend $240,000. Now let's imagine the actual equipment itself, let's say, costs $200,000, and then I have a $40,000 delivery and setup, right? And maybe I have to make some structural modifications to the to our physical plant, so our our office space, in order to make the equipment work. I might have to bring in a different power supply, right? So a big scanner probably requires, you probably can't just plug it into your standard wall plug. You might need something that's a a higher voltage, or whatever. So that, but the whatever your costs are, you need to make sure when you're doing this, and we kind of talked about this last time, you want to make sure you capture the entire cost of purchasing and installing the equipment. And so whatever costs might be associated with, you have the actual equipment, of course, but I think I told you my story last time about that backup battery that we bought that was like $300,000, and then it turned out we didn't have an adequate power supply, and we had to do some other modifications. We wound up having to spend like $100,000 to install our $300,000 battery. We hadn't accounted for the $100,000 in installation costs, and that wound up coming out of our next year's budget. So we had to find $100,000 in our next year's budget in order to cover that. Otherwise, we'd have just had this big battery sitting in the warehouse doing nothing, right? So in this case, let's imagine that the equipment is going to cost us $200, and the setup costs are going to cost us $240. And pardon me while I'm going to be looking over here at my other screen, away from my camera. Equipment $240. Now, we're not going to have any equipment costs in the out years, right? So after year zero, we're assuming we're not going to buy any more equipment. If we were doing a more complex analysis, we could plug some things in, but this is kind of a basic analysis. So we're just going to assume that we have just the one expenditure. All right, now we're going to start to build our P&L. So our top line is going to be our revenue. So we're going to type in revenue, right? And our revenue doesn't start in year zero, right? At time zero, we don't have any revenue at time zero. So we're going to go all the way out to time one, and we're going to say, okay, it's going to equal $80 times 5,000 visits, right? So if you've got the formatting the same as me, you should be able to just type equals B2 star or asterisk times B1. So that'll give you 80 times 5,000. Right? So you should have 400,000. Now, if at any point you get lost, just chat me, or feel free to shout out. I may not notice the chat if you, just pause me and I will stop, okay? So our revenues are simply price times quantity, right? So our net revenues would be our adjusted, contractually, our adjusted net patient service revenue per unit, right? So we're going to take our gross revenue, we're going to take our allowances for contractual adjustments and come up with our net revenue. So this is our NPSR per unit times our 5,000 units, right? And then, so that's our revenue. Then we're going to start to get into expenses. So supplies, again, don't start until, or we're not going to account for them until the end of year one. So supplies are going to equal 40 times 5,000, right? So we're going to have 200,000 in supply costs. What else do we have? We have labor, right? And labor is going to cost us, it's a fixed cost, it's going to cost us 100,000. And then we have our overhead, and it's going to cost us 5,000. And the way I'm maneuvering around on the sheet, I know you can't see, is I'm just using the arrow keys. You can use your mouse or you can use your arrow keys. So right now I'm just using the arrow keys. Then we have one thing that we haven't talked about is what? So if I have equipment, right? I'm buying equipment. What is an expense that I have for equipment that I don't have listed in column B, but would be implied? So this is an asset that's going to last us 4 years, right? So what expense do we have when we have an asset with a long life? Let me see, depreciation, good. Okay, I don't know if I can't, all right, I have to, maybe I have to turn off the share in order to see the chat. Okay, so if you run into a problem, you may have to unmute in order to talk to me. Let me go back to the screen. So we have to calculate depreciation. Wait, I got the right, so depreciation. Now this is a not-for-profit entity, and I'm going to keep, in order to make the columns nice and neat and be able to see the whole word, you just take your mouse, your cursor up between the two columns, and it transforms from that cross shape into this like double arrow if you're right in between, and then you just double click in it and it'll resize the column to fit. So you can do that over here too. Right? Okay, so depreciation, also going to be a out year expense, right? Out year means end of each year, you know, going forward. So depreciation. So I've got equipment that cost me $200,000 plus $40,000 in installation costs. So my total PPE purchase was $240. This piece of equipment has a 4-year useful life. So how much depreciation am I going to take each year? And I will tell you that even though the equipment itself only cost you $200,000, you include the installation costs and all the other miscellaneous costs that it took to bring it on board. So, right, good. So we're going to just do straight line depreciation. So that means we're just dividing, we're going to take the equipment cost and divide it by its useful life. So the depreciation charge is going to equal 240 divided by 4, 60. All right. Those are all the expenses that we have that are associated with this particular piece of equipment. So at this point, we're going to calculate the operating income. Okay. And the operating income is going to equal the revenues minus, and you could do, you know, minus 200, minus 100, and you could just, you know, go down the columns. Instead of doing that, to take advantage of working in Excel, I'm going to say, I'm going to take F4, which is my revenue, and then I really just want to subtract all of these columns. So I'm going to say F4 minus sum, and I'm going to open the parenthesis, and I'm going to click on 200 and then drag down to depreciation, which you can't see because it's blocked by the editing window, but it's okay as long as you get it. All right, so my operating income in year 1 is 35,000, right? And at this point, we could assume, we could wedge in, and I didn't include it, but we could wedge in below operating income. We could include interest. I wasn't planning on doing that, so we'll skip that for now. But then if this were a for-profit, we would put in taxes. And I do want to go ahead and put in taxes because what I may do, if as we have time, maybe either this time or next time, is we can convert this, if we design it properly, we can convert this very quickly into an example of a for-profit entity that pays taxes. So let's go ahead and type in taxes just for future use. And so taxes are going to be based on the operating income or taxable income. If this was a, this would be operating income, and it would be equal to taxable income because we don't have any interest expenses. So we'd have to tweak it a little bit. So operating or taxable income times the taxes, and so that's going to be 0, gives us our net op income. And I'm just going to make it a little bit wider again. And so net operating income is going to be operating income minus our taxes. And you're like, okay, well, that's no big deal. I'm just, I'm doing that so that if we were to change our taxes now, so check this out. If we were to change our taxes, I'm going to just change it for a second. But let's say we had this firm paid 21% in income tax. It's already built in so that we can manipulate the amount of taxes just by changing the tax rate over here. But I'm going to change it back to 0, okay, because we're going to play that this is a not-for-profit. One more column we want to add is going to be net salvage, right? And we'll get to that in a minute. We have 0, no net salvage in year 0, no net salvage in year 1. And then we're going to, now we've got, at the net operating income, we have our operating income, but really what we're interested in, I think I said last time, was at this point, what we're interested in, particularly when we're dealing with projects inside of an organization, is we're interested really in the cash flows and not so much the accounting income, right? So we want to take what we've got and convert it to cash flow. So based on what I've got, what you've got in front of you, hopefully, what do I need to add to net operating income in order to get to cash flows, in order to estimate cash flow at this point for this project? What would I need to add to net operating income? Or I should say, give you a hint, add back to net op. Yes, good. Good, I'm going to add back my depreciation expense. Why am I going to add back depreciation expense to my accounting income in order to get cash flow? What is it? Why am I adding back depreciation? It's an expense. That's what you taught us. All right, thank you, Jisoo. Yep. All right, so it's not a cash expense, right? If I'm trying to get to cash flow, right? Operating income, accounting income, does not equal cash, right? So in order to accurately represent the amount of cash that the organization is getting, right? We actually get in 400,000. We actually spend 200,000 in cash and supplies. We actually write checks for $100,000 in labor. We, the overhead is an actual expense to the organization, and it's kind of being allocated to us. So we don't actually cut a check for 5,000 from this project, but this project is allocated an actual cash expense of 5,000. Depreciation is not an actual cash expense, right? The actual cash expense was the $240,000 at time 0. But to kind of review, right, why do we use depreciation as opposed to just booking the $240,000 as an expense in year 0? Is that we want to capture the economic value that's being used in each year. Right? So we're actually using up 1/4 of that 240 in each year. Now the work we're gonna do with this is gonna kind of negate that, because again, we're not really working in this case with accounting flows. So we're going to go ahead and add back depreciation. So I'm just going to type equals, and I'm going to pull depreciation, right? And then I'm going to have my net cash flow, net CF for net cash flow. And net cash flow in year 0 is equal to the equipment expenditure. Net cash flow in year 1 is equal to my operating income. Well, really, I could do this because I can. Yeah, I can just do sum and sum up those 3 categories, right, or lines. Mostly because net salvage is 0 right now. I'm adding back my depreciation, so I have my net operating income of 35. I'm adding back my depreciation because that's not a cash expense, right? So this 35 is an accounting income rather than a cash flow. I add back 60,000 to represent the 60,000 expense that I took, and I wind up getting 95,000. Now, why do I want to have depreciation up here? If this was truly a not-for-profit, I wouldn't need to do that. Okay, so I wouldn't need to have depreciation here and then depreciation again here, because with a not-for-profit, it's just a shell game of I'm adding it here, subtracting it here, and adding it back down here, right? So that's kind of a waste of time. It has real impact, though, if this was a for-profit and you were going to pay taxes on the operating income, right? Because depreciation would reduce the taxable income, then you would add the depreciation back to get at the cash flow. So you do want to have it if it is a for-profit. And so what I said was I want to be able to use this to model a for-profit entity in a minute. So we're building the model in such a way that we can quickly convert it into a for-profit example. Okay, so if you were truly working in a not-for-profit entity, you wouldn't bother dealing with the depreciation, because the only reason you're including the depreciation in the kind of the operating income portion is because if you were for-profit, it would reduce your taxable income. Right? So that's year 1, right? At the end of year 1, the entity has made $95,000 in cash as a result of buying its $240,000 piece of equipment. All right, now going forward, in year 2, we are going to assume that we continue to get $5,000 in revenue. We're going to assume that we're going to get this stable amount of net revenue, but we are going to allow now for a amount of inflation of 5%. We had that down here. We're going to have this global inflation rate that's going to apply to both our revenues and our expenses. Okay, and we could tweak that assumption later if we want to, so that we have maybe expenses going up faster than revenues. We could tweak it so that labor was going up faster than supplies. And there's a lot of things you could do, but I want to kind of demonstrate the most simple assumption, which is that there's kind of this global inflation that's applying to everything at the same time. So going forward then, if net revenues are going to increase by 5% per year, I'm going to have the easiest thing to do would just be to assume, the easiest thing to do is just take 400,000, right, my entry here, times 1.05, right? Now, why can I do that? Well, because my volume is going to stay constant. It's still going to be 5,000. The inflation isn't going to apply to the volume, right? In the sense of like, we're not going to do 5% more volume. We're going to assume the volume stays at 5,000. So I could then multiply that by 80 times 1.05, right? So now I am increasing, I'm specifically applying the 1.05 to the net revenue figure. But what you're going to see is it makes no difference because of the commutative property. I think that's the right phrase. Commutative property of multiplication, right? It doesn't matter if you multiply 80 times 5,000 times 1.05, or if you multiply 1.05 times 5,000 times 80. It doesn't matter the order in which you multiply three things or two things. The result is always the same. All right, so just to simplify, I'm going to get rid of that more complicated way that I wrote it. I'm going to go back to what I originally did, which is simply I'm going to take the 400,000 that we had from last year times 1 plus the inflation rate. Right? I guess that's not actually simpler than what I just did. But I want to take it and do it as what I'm building here is a financial model. Okay. If I hard code in, like if I type in 1.05 into this cell, it's always going to be 1.05. If I say it's, instead of typing in 1.05, I say 1 plus the inflation rate, whatever that happens to be here in cell B6, then if I decide I want to change the inflation rate later on, I just go to B6 and I change it from 5 to 3 or from 5 to 7 or whatever I want to do. The key here is that I'm building this, I'm building it in Excel in such a way that I can very quickly change my assumptions later on, okay? So I could like I said, I could hand jam in 1.05 and that would be fine. But what I'm really trying to do is build this model that becomes very flexible so that I can make changes later on. All right, now I'm going to copy that. I'm going to copy this cell in a second, and I'm going to copy it across, right? So I'm going to copy this across. So let me show you what I'm going to want to do is anchor this cell, this reference, B6. I always want it to be 6, even as I drag it across. Let me show you what happens if what I need to do, what you should do is now go ahead and hit, while your cursor is on top of the B6, like mine is, hit the F4 button, and that will insert 2 $signs, one before the B, one before the 6. I know this works with Windows machines. I'm not 100% sure if it works with Apple machines. And if you are not working in Excel, but instead working in Google Sheets, I'm not 100% sure how that actually works. So, but in Excel, in Windows in particular, on Windows machines, you can just hit the F4 button. It's a shortcut. It inserts a $sign before the B, the $sign before the 6. If your machine doesn't do that when you hit F4, then what you want to do is type in a $sign before the B and a $sign before the 6. What that will do now is when I drag across, it will keep the reference locked on B6. So if I go here, you can see it's the prior cell times 1 plus B6. Oop, got a chat. For Mac, it is, yeah, function F4. Okay, so that's the same as what I'm. Yep, that's what I'm doing. Okay, or do you have to hold down the function key and F4? Is that what you're saying? Because right now I'm just doing. Okay, so you've actually got to hold down the function key. I don't have to hold down the function key. I can just hit F4 and it works. All right. Okay. Good. Let me just so if you've done that, you've done it correctly. So good for us. Let me just show you what happens if you don't do that. So I'm going to go and delete if you hit F4 repeatedly, it eventually takes them away. So if I do that, so don't do that. Don't do what I'm doing right now. Leave it the way it was. If I don't put the $signs in, notice what happens. Oh, hey. So when I drag, this first one works fine, but this one's the same as this, it didn't work. So if I click on it, what's happening now is it's grabbing cell G2 as its reference point, but it's multiplying it by 1 plus some blank number because it slid the reference along, slid it over at the same time. And then here, I've got it, right, it's referencing cell H4 at 420, and it's multiplying it by 1 plus the word labor, which of course is nonsensical, right? You can't multiply anything times 1 plus the word labor. So going back to my original situation, I'm gonna fix that at 4, right? Fix what I was doing. So if you wind up with some funky, you know, like what's happening, why am I, you know, I thought I was multiplying by 1.05, trying to build this cool model. If you get some funkiness, double check to make sure that you locked the reference by doing that $sign thing using your F4, okay? So that said, right, supplies are also gonna go up by 1.05. So what I can do is I can highlight this whole row and just drag it down, right? And now I've got, it's referencing the supply number times 1 plus 0.05, right? And then over here, it's referencing the prior year's supplies and it's increasing it by 1 plus 0.05. So lovely, right? And we're gonna assume also, basically, so let me just pause for a second. Is everybody with me? We good? Okay. Anybody having trouble, you can privately message me. Don't be embarrassed. If I don't want you to be sitting there going, I have no idea what he's doing. Okay, wait, how did you get the supplies number? Okay, so let me delete. All I'm gonna do is, all I want is to take this formula, right? And I wanna bring it down here, okay? So what I can do, really all I'm doing is I'm copying this formula down. So in Excel, if you take your cursor and you put it, you see how it's got like a fat cross right now. If you bring it up and you put it, there's a little dot in the bottom right corner of the cell. If you put your cursor, hover your cursor over that, it changes from a fat cross to a kind of a skinny cross. That allows you to copy the form, whatever's in that cell, down. So I'm dragging it down, right? And now the same formula that was above is now here, right? And if you anchored the reference to inflation, then it should have copied down, okay? I can do that with the whole row at the same time. So I highlight the whole row, go to the corner, right, to that little corner dot. My cursor goes from a fat cross to a skinny cross, and then I just drag it down. And that copies this, it copies the formula, right, into the whole row. Does that work for you, Emily? Okay, great. So I'm going to do the same thing again, because I know that I'm going to apply that same inflation factor to both labor and overhead. So I'm just going to drag it down, right? And everything is now being multiplied by 1.05. Now, depreciation. Does depreciation get adjusted for inflation? And the answer is no, right? It's a constant. It's just going to be a quarter of whatever the purchase price was, because the purchase price isn't changing. It is what it was, right? So in this case, depreciation, I can just say equals, and then go back to the 60,000. And I don't need to lock the reference in this case. It decided to fill in the 1.05, so I'm just going to drag it across. There we go. I don't need to lock the reference because this cell says equal to this cell says equal to this cell says equal to this cell, and none of them are changing, so it doesn't matter. Can you show the equation G4? Yep. It's just equals the it simply equals the number to the left. All right. Not 8. What do you mean not 8? Okay. I mean, if you didn't set it up exactly like me, your numbers aren't going to match up. They'll be off by however many cells you've shifted your P&L by. Okay. So we've got 60,000, and then operating income is the same formula, right? So we can just copy that cell over, as well as taxes, as well as net operating income. So we can just copy all that over. What did it do? Oh, because this one, we need to lock this one, B8. So with taxes, so I lied, taxes not the same. Taxes, you have to take your operating income, which is F9 for me, times taxes, the tax rate, and the tax rate needs to stay constant. So you're going to want to lock the reference for taxes. Once you do that, you can copy that formula over. There we go. Now everything is fixed. All right. Now, depreciation is going to be the same again. So this is just equals F8. So I can just copy this over, right? And then net cash flow is still going to be the same, like that. Now there's one thing we're missing. Okay, is everybody with me at this point? Do I need to back up? And if you're embarrassed, just message privately. Yes, do taxes again. Okay, taxes. I'm just going to delete the row. Oh no, that's not what I put it. Delete this row. So the formula for taxes is going to be my operating income times the tax rate. And I'm going to copy it. I'm going to copy this formula to the right. So, so I need to lock the reference for the tax rate by doing the F4 trick. Okay, so it should be F9 or whatever your operating income cell is times the tax rate. For me is B8, but when you do the tax rate, you want to hit the F4 button and get it to have the $B, $8. Okay, and then you're just going to copy that over. And okay, net operating income is going to be simply the revenue. So it's going to be equals revenue minus, and I'm going to do the sum. Oh, did you say net operating income or operating income? Sorry. Net operating income is going to be operating income. Let's copy that back. Operating income is going to simply be the revenues minus the sum of all the expenses from the operations. So it should look like that. Good, Aaron? Okay. And then taxes, and then the net operating income is simply the operating income minus the taxes. And taxes are 0, so there's not going to be any effect there. And then that formula, we can copy that formula across, right? And I did that correctly. And then depreciation, I had as just equal to the depreciation number up above. I'm just bringing it back down here. So you should be able to just copy that across, and you should have a row of 60s. Okay? And then your net cash flow is going to be the sum of the 3 numbers, the net operating income, the net salvage, and depreciation for 95,000. Right? And then you should be able to copy that across. There's nothing fancy going on there. It's just a sum. So what's missing? What do we still need to factor in here? Good. Mohammed's got it, 25,000 in salvage value. So at the end of year 4, in addition to all the income that we earn in year 4, we're also going to get our salvage. So just simply hit equals salvage of 25. So I'm going to insert that in there. Right. And again, I could just hand jam in 25,000, but what I'm trying to do is have all my variables over here on the left and build my whole equation based on, my whole P&L using the variables from over here. So that way I can change my assumptions and it'll feed through my whole, estimation very quickly. So don't do this at home real quick, but let's say I want to change now that I've done all this, let's say I want to change my inflation rate from 5% is too high. I think it's really going to be 2%. I can just change the inflation from 0.05 to 0.02, hit that, and boom, it's all done for me, okay? If I think it's actually going to be higher than that, it's going to actually be 0.07, just type, and all changed for me, right? So that's the benefit of plugging all this stuff in. If I want to say, you know what, I think my net revenue is not going to really be 80, I think it's going to be 90, I just change it to 90, and it changes everything, right? It changes all my revenue numbers. So if I think my supplies are understated, I could change them to 50, right? And it changes, and everything just feeds back through. So that's the beauty of these kind of doing your estimates this way. And this becomes really useful when you're starting to model stuff and you're like, all right, we're going to do this in chapter 15. I want to change some assumption. If I program it into Excel, I can do it boom, 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 just as fast as what I just did, right? So I could potentially, if I want to see 3 different scenarios, and we'll do this in chapter 15, I want to see a scenario where my revenues are 80. I want to see a scenario where my revenues are 70. And I want to see a scenario where my revenues are 90. And I want to see those 3 different variations. That's called sensitivity analysis, where you're manipulating one variable and you're seeing how sensitive is the outcome to the change in this one assumption. You can do it very quickly. You just copy this, right? So and again, you don't have to do this right now. I'm just going to copy it and delete it in a second. But I could just copy it, paste it down below here, right? All the relationships are still there. So let's say this version, I wind up with net cash flows, right? At the end of year 4, I wind up with 134,000, but that's based on revenues of 80. I want to see what it looks like with 90. And I would be able to very quickly be able to compare, all right, here's my cash flows with, if I assume revenues of 80, here's my cash flows if I assume revenues of 90, right? See how fast that is. That's a useful, that's what makes using a spreadsheet so powerful, as opposed to if I had hand copied all this, I would have to, do it all mechanically again. So one of the things that you want to learn how to do is, how can I do this really fast? It takes a little longer to set it up, right, where we were going and doing references, but not that much longer. And man, it makes it really fast, right, when you get into the whole, like, I want to start comparing, contrasting, assumptions. All right. So now we've got all right, so now we want to start to do some analysis, okay? So now we've got our cash flows. And the question we need to answer is this a good investment? And if so, what are its returns for us? So in Finance 1, we talked about in Finance 1, we talked about break even. In Chapter 9 of Finance 2, we've worked with net present value and internal rate of return. So we're going to do those today. And then we're also going to do a new one called modified internal rate of return. All right. So what I want to do now is, is calculate the how do I want to do this? Yeah, I'm just gonna go ahead and do it on the same sheet. I want to calculate my break even. So this is kind of a crude estimate. I'm gonna put this new number down here. And I'm gonna make this like my cumulative earnings. So at the end of year one, how close am I to breaking even? Well, breaking even means I've got to cover my $240,000 in initial investment. So breaking even asks, how long is it going to take me to cover that $240,000 in investments? And if I never cover those $240,000 investment, then I don't have a break even point. But if my revenues eventually cover my cash flow, my initial cash flow, my initial out cash flow, then I can say that I can establish at what point is my break even. So you would never do a project that doesn't have a break even, right? So if the sum of these four cash flows in years 1 through 4 never add up to something more than the initial investment, then I would not have a break even. So first thing is you've got to see, okay, do my cash inflows cover my cash outflow at some point? If you say no, then this project is dead on arrival, right? You're not even going to consider it. So that's kind of, you're not going to approve a project based on break even. You're going to approve but you can reject a project based on break even, and you would reject the project if the sum of these cash flows never covered the initial purchase. So we can test that real quick by just saying sum, and then choose all four cash inflows, and we get 434. So 434 is bigger than 240. So we know that it breaks even, but we don't know how long it takes to break even. So does it take, it clearly doesn't take all 4 years. Does it take 3 years? Does it take 2 years? And kind of eyeballing this, right? In year 1, you're going to make 95. That's not enough to cover 240. In year 2, you're going to make 99. Well, 99 plus 95 is still less. It's like 194. So that doesn't cover it. So in year 3, you're going to you'll have 95 plus 99 plus 104. That's like 30, like about 300. So 300 is more than 240. So it's going to break even sometime in year 3, right? So this is not like, there's not like a simple formula here. You're going to have to do kind of a couple steps. But we can kind of build the cumulative relative earnings by saying, all right, our initial outlay was 240, and we can add to it at the end of year 1, we have not covered 145,000, right? So what I did here was I added 95,000 to minus 240,000. So I still have to cover 145,000. So my cumulative cash flows at this point are negative 145. And then if I take this 145 and I add 99,750 that I earned in the next year, then I am still short. My cumulative cash flows now are 45,250, right? So I spent 240, I earned 95, so 240 plus 95 is 145. That's my cumulative cash flows at this point. At the end of year 2, I earned 145. I was at 145. I earned another 99. So my cumulative cash flows are now 145, negative 45. In year 3, I start with negative 45 cumulative, add my 104, and I now have a positive 59. So I know that my break even happens sometime in year 3. So my break even is going to be 2 plus the percent or the share of the year of the third year that it takes me to cover the 45,000 that I have not yet covered, right? So what do I want to do? Well, I want to say I'm going to earn 104,738 in year 3. I still have to cover 45,000. So what share of year 3 is it going to take to cover that 45,000? So I'm going to take the 45,250 and divide it by the 104,378. And you can make this, you can change the sign just to, so it's going to take me 43% of the year, or 0.43 years, right, to earn the 45,000 that I need. What did I do? I divided the amount that I needed to earn by the total amount that I'm going to earn in the year. So I'm going to have an excess of 59,000 at the end of the year. But what I want to do is take the shortfall that I had as of the end of year 2 and say, okay, what portion of year 3 do I need in order to cover the 104? Yeah. So to change this to a negative, to change the sign, I'm just putting a negative in front of it. You see that? And if you wanted to, you could put it in parentheses. You don't have to.
What is the 0.43 telling us?
That's 43% of the year of year 3, right? So in year 3, I'm going to earn 104,000. As of the end of year 2, I had not earned back 45,000 of my initial investment, right? So at the end of year 1, I had earned back 95,000, leaving me with a shortfall of 145. At the end of year 2, I had earned back, I had covered I had covered whatever this is. I could do a cumulative. I had earned a total of 194,000. At the end of year 3, I have earned 299,000, right? So these are my cum earnings, right? So again, there's not like a single formula for this. You can't just, plug in. You have to kind of understand the logic of it. Okay, so at the end of year 1, I've earned 95,000. How much do I still need to earn to break even? I still need 145,000. At the end of year 2, I had earned 95 plus 99. That's 194,000. So I still need to earn another 45,000 to cover my 240. At the end of year 3, I've earned 599,000. 299,000. Sorry, I had earned 299,000. That does in fact cover my 240. So, but I don't break even at the end of year 3. I actually break even sometime between year 2 and year 3. Does that make sense, Ariana? So what I'm trying to figure out is how much of year 2, how much of year 3 do I have to use to cover what's left that I need to earn? So the 0.43 is 43% of year 3 is spent earning the last 45,000 that I need to break even. So that would then be, so this is 2 years. So my break even is going to be 2 plus 0.43, or 2.43 years. Do the cumulative earnings. So the first year is just whatever you earn, right? The second year is going to be The first year, I should have done this different. Should do this. Let me change that. Is going to be, so the cumulative earnings should be what I earned, what I had cumulative at the end of the prior year, plus whatever I earned this year. And then I could just copy that formula. Right, so so in year one, it's whatever you earned. In year two, it's what you earned last year plus what you earned this year. Right, so this plus this. In year three, it's what the cumulative that you had in the prior year plus whatever you earned this year. Does that make sense? Okay. So then the break even line is, maybe I should call that shortfall. Right. Again, there's like, it's not really a form, it's not like NPV where there's like a rigid way of doing this. But really what you want to get at is, how many years and then also, including fractional years do you need in order to cover, in order to get to break even. So because this has a break even of 2.43 and that's less than 4, then this is a potentially viable project. It is not, we don't know that it is in fact viable yet, but we know it is a potentially viable project. Does that make sense? I feel like I've probably lost you guys on this break even thing, even though it's actually pretty simple. Can you go over where you got the 2 and the 2.43 from? Yes. Okay, so the 2 is simply how many years is this, right? Cumulative number of years. So at this point, that was 1 and that's 2, right? So as of the end of year 2, my cumulative earnings are 194. Then I really need to go into year 3 in order to earn everything that I need. So I need not just 2 years. I don't need a full 3 years, right? I need an additional, I need 43% of year 3 in order to finish paying off 45,000. So what I did was I said, I took 45,250 and I made it, because it's negative over here, I made it positive. And I said, what percent of the amount of money that I'm going to earn in year 3 do I need to cover the existing shortfall in order to break even? So I've got to earn $45,250 in year 3. What portion of year 3 is going to be spent earning that $45,000? And that answer is 0.43. So then I just add 2 years plus 0.43 years to get 2.43 years to break even. Does that make sense, Kat? Got it. All right, good. All right. Okay, well, let's so we've decided that this firm can actually break even. Sorry, not the firm, but the project can actually break even. So that's good. But that doesn't tell us whether we should do it or not, right? So the tools that we've worked on that actually tell us whether we should do a project or not so far are net present value and IRR. So we're going to go ahead and calculate net present value and IRR now. And to do that, I want to neaten this up a little bit. So what I'm going to do is create another sheet. So all I do is I go down to the bottom of my page and I click on the plus sign, it creates another sheet. And we'll do this, will be our Npv sheet. And what I'm going to do is, for the Npv sheet, is I'm going to bring the data over. Let me blow this up some. And I'm going to say my corporate cost of capital is going to equal, and I'm going to go back here and grab it. Right, so all I did on sheet 2, I renamed it NPV. is I typed CCC equals, and then in cell D1, I just hit the equal sign. I'll just do it again. Okay, equal sign, and then you can flip and grab data from other sheets. So you hit equals, then you go down here to the sheet, the original sheet we were working with, click on that, and then go to the corporate cost of capital, right? And just say, I just want to pull that in here at 0.1, okay? Now I'm going to put a header here on the year, and then cash flow, and then PV. So I'm going to make 3 columns, and then I'm going to have a year 0, year 1, year 2, year 3, year 4. All right, everybody with me? So we really haven't done any calculations at this point. I've just done a little bit of typing, except for you know, grabbing the 10%. All right. So everybody was able to create a sheet. Okay. All right. If Vicky's got it, I'll assume everybody's got it. All right. So now I'm going to go grab from the previous sheet each of the cash flows for each of the years. So I'm going to type equals at year 0, go back to the sheet, and I'm going to grab the cash flow from year 0. Right. So year 0 cash flow is negative 240. Then I'm going to hit equals, and I'm going to go back to the sheet again, and I'm going to grab the net cash flow for year 1. Hit enter. Then for year 2 cash flow, I'm going to hit equals, go back to the sheet again, grab the year 2 cash flow. Year 3, type equals, grab the cash flow for year 4, and then finally equals, and then the cash flow for year 4. And that's it for now, right? So that's pretty mechanical. There's not a lot of logic there. It's just, you know, click and grab. Okay, I'm gonna neaten this up. So I'm highlighting my cells that I'm gonna work with, and I'm gonna just hit the comma because I like to have it in business notation. And then I don't really care about the pennies, so I'm just gonna click decrease decimals here, just to make it look nice. Doesn't have to, but I do like to make it look nice. Maybe we'll put that centered. There we go. All right, now I'm happy and everything looks nice. Okay, so remember the formula for NPV is NPV is equal to the present value of the cash flows minus the investments. I'm just going to type that down here. PV of CF is equal to the investment is equal to, and then the NPV is equal to. Now we know what the investment is. The investment is this. So we're just going to say equals cash flow at time 0, right? It was 240. So now we just need to calculate the present value of the cash flows. Well, the present value of the investment is 240. We don't care about that right now. What we care about are the present values of these respective cash flows. I'm going to show you how to do this kind of mechanically, and then I'm going to show you how to do it using the Excel form, the formula for present values of the cash that Excel has built into it. Okay, so let's do this mechanically first. And the way we're going to do that is we're going to use the present value formula, right? The present value formula is present value is equal to future value divided by 1 plus the interest rate raised to the number of years. Remember that? So the future value in this case, because we're trying to bring everything back to year 0, the future value in this case is 95,000. And then we're going to divide that, and I got to open a parentheses, by 1 plus the interest rate, which is the corporate cost of capital, right? Raised to the number of years. Well, in this case, the number of years is 1, right? And then down here, it's going to be 2, then down here, it'll be 3, and down here, it'll be 4. So in order to simplify things, I'm going to tell it to raise to the number of years. I'm going to choose number of years. Something I forgot to do was I need to lock the reference for the discount rate or the corporate cost of capital, interest rate, whatever, to D1. So in order to lock it, I'm going to hit my F4. Okay. So this is just our good old present value of a future lump sum, the future value of a lump sum, right? So if we're getting some amount of money in the future, how much is it worth today? That's the amount of money in the future divided by 1 plus the interest rate raised to however many years we have to wait for it, or however many periods we have to wait for it. So if you have that formula, then we should be good to go. You should have 86,364. If you don't have that, go ahead and send me a chat. I'll go back up. So the answer should be 86,364. Double click on it. That's what it should look like. The formula should look like is D5 is my future cash flow, right? My lump sum. My divided by 1 plus the interest rate. Well, the interest rate is the corporate cost of capital, or our discount rate, raised to the number of years, which in this case is 1 year, right? So it should be 86,000. Now, if you've done that correctly, we should just be able to drag it down. Okay, so if you go to year 4, you've got D8 for me, which is referencing the $134,000 cash flow, divided by 1 plus 0.1, raised to the C8, which is the year 4. Right? So you should have that. Does anybody not have that? Need me to go back up? You can send it private if you, and I'll just do it again. All right, I'm not seeing any requests. So now that was the hard part. So now the easy part is we just sum, not S9M, sum, right? We're going to add up the present values. Right? And then the difference, or the sum here, because I've got the investment as a negative number, I can just add it to the PV of the cash flows. Yeah, got to type equals sum, right? And I get an NPV of 99,682. Okay, so is this project a go or a no-go? All right, Jisoo, good. It's a go, yay. All right, so this piece of equipment is a go, right? Because when we discount the future cash flows to account for the risk of the project, the cost of capital, so we're going to, we could use the capital for something else, and all that's incorporated in terms of trying to evaluate those future cash flows. Then yes, we are in fact going to want to do this project because it has a NPV of greater than 0. Right? Okay, so that's NPV. So the other way, right? You don't have to do this. Excel will do this. Will do this portion for you. Okay. So you just need to set it up in this fashion. So you go back and you take your cash flows, and there's a formula, and it simply equals NPV. Right? So type in the next cell over, right? So type in equals NPV, open parentheses. The rate is the corporate cost of capital. And now make sure you do this, pay attention. You want to incorporate just 1 through 4, okay? And it's the cash flows, not the present values. All right, so you should have, if you've done this right, you should have equals NPV, open parentheses. D1 is a reference to the corporate cost of capital, and you don't have to lock it, do the F4 thing, because we're not going to copy this. And then comma, D5 through D8 are the positive cash inflows. I don't know why they call this the NPV formula, because it's not the NPV. It is simply the present value. It's the present value of an annuity. So I've never understood why Excel calls this the NPV formula, because it's not net of anything. So for whatever reason, this is the formula you want to use to get the present value of the annuity, which in this case, or the cash flows in this case. And so that gives us the same result as before, right? And so then you could, just say that, and then equals sum, right? And so you get the same result. So you've got two ways to do this. One is, kind of the easy way. One is the not difficult way, right? So it's not particularly hard to do that. So I'd like you to be able to do both ways, at least for now, for our exercises. But you should pay attention. These formulas are really nice. They go really fast, but you do want to learn, like, what is it that's operating behind the scenes. And sometimes it's useful to build your sheet with that built in. All right. Let's see, we've got 5 minutes. We'll go ahead. All right, to do IRR, we're going to copy this sheet. So right click. If you right click, you put your cursor on top of the title, the sheet title NPV, and you right click, you'll get this these choices. Choose move or copy, and it comes up and it says to what book. Well, we're going to keep it in this same book, and we're going to move it to the end, and we're going to create a copy. So you're going to click on the box that says create a copy, and then hit OK. So now it tells you this is NPV2. All right, we're going to rename it IRR. We're going to delete this. And we're going to change instead of having a reference back to sheet 1, which was where all our data was, I'm just going to type over that now. I'm going to hard code in 10%. That should have no effect on the numbers that you're looking at. Okay, so the numbers should not have changed. But if you go up there and you manipulate it now, you're going to do 0.12. What does that do? Right, well, that changes. Well, let's go back to 0.1 for now. Okay, IRR. What does IRR tell us? Well, IRR tells us is still a go, no-go thing, right? What's the rule for IRR? We want it to be, what do we want IRR to be? Good. IRR greater than CCC. Good. Okay. I'm going to change this. Let me see. Yeah, I'm going to change this from CCC to IRR. Right. And we could type over here CCC equals 0.1, right? Just to remember. Or we could even grab it from from before. Doesn't matter for this exercise right now. IRR is the discount rate that, if applied, makes the present value of the cash flows exactly equal to the investment. So right now we have a positive NPV. that means that the IRR is greater than 10%, but we don't know how much greater. So what we want to figure out is how much bigger does IRR, does our discount rate that we have built into our assumptions have to go? How much higher does it have to go in order to drive down the present value of the cash flows, right? Drive them down until they're just equal to 240,000. So if I make IRR 0.12, right, we go from having a NPV of, what was that, 350 or something? From 339, if I make it 12, it falls to 324. If I make it 15, it drops to 304. And I could just keep on doing that, right? 0.17, and it's going down, right? You get the idea, right? As the interest rate goes up, the present value goes down, right? Because you're discounting it by a higher and higher amount. There is a cool technique, and we'll finish on this. There is a cool technique that is built into Excel. So go to Data, up here on the top, Data. Okay, so File, Home, Insert, you should come over to Data. And then down in the, I forget what these things are called, but down in this menu, you'll have Get and Transform, Queries, Data Types, Sort and Filter, Data Tools. Forecast is what you want. And there's one called What If Analysis. So click on the What If Analysis, and you'll see one called Goal Seek. So I want you to choose Goal Seek. Okay, so click on that, and you should get a little window pop up. Okay, so if you're not with me, go back to the top, choose Data, then down in the menu bar, choose What If Analysis, and then that'll give you a couple options. Choose Goal Seek. Now, we want to set cell. So what we're going to do is tell it what we want it to do. We want to set cell, we want to change IRR, this number, so that the present value of the cash flows drops to 240,000. So we're going to tell it to set PV of cash flows to 240,000 by changing the IRR. Okay? So you're going to make those selections, and then you just hit OK and let Excel do its work. And what you get is it raises the discount rate to 27%, right? And when you use a discount rate of 27%, that drives the present values low enough so that when you add the present value of the four cash flows together, they equal 240,000. So I'll do it one more time. So those of you that weren't able to follow, I'm going to go to Data, right over here up at the top, Data, What If Analysis, Goal Seek. I'm going to tell it I want to set the present value of the cash flows. It says to what value? I say 240,000 because that's the value of our investment. And I want to get there by changing the IRR. And hit OK, right? And it changes my IRR to 0.27. The other way that you can do this is you can tell Excel, and I'll stop on this, you can tell Excel, give me the IRR. Right? In which case, then you just highlight all 5 cash flows, including the original one. Right? It gives you the option to put a guess in. I don't even know why we bother with a guess. And you hit Enter, and you get 27%, which is the same thing as 0.27. So you can make that pretty, right? So, all right, that's kind of most of chapter 14. We're going to come back next time, and we'll work on another idea called MIRR. So we'll practice this with this worksheet, and my daughter's having a good time. So I'll send out this worksheet. Hang on to your worksheet. If you didn't have exactly what I got, you can look at my worksheet after the fact. Next time we'll continue to work with this worksheet. We'll do a few more tweaks. We'll work on MIRR, and maybe we'll do another example. All right, so that's it. Let me stop